Welcome back, you legends. I'm Dr. Ken. Let's get right into this video. This is going to be a short and sweet update ahead of the Fed meeting tomorrow. Today we had a bit of a rally in the Dow, the S&P, and the NASDAQ. All three indices up on the day. Leading were communication services as well as cyclicals, energy, and financials. The defensive sectors, including healthcare, consumer defensive, and utilities, as well as real estate, lagged today. So this was a risk on move ahead of the Fed meeting tomorrow. Let's take a look at the daily chart of the S&P 500, and right off the bat, what jumps straight at us? Well, a few things. Number one, look at this volume. Absolutely pathetic, anemic volume in the last couple of days. So this rally ahead of the Fed meeting has very weak conviction, not a lot of volume coming in to buy ahead of the Fed meeting. That's number one. Number two, guys, we are hitting critical resistance levels. This is the back test that I've been waiting for this ascending prior support line, now a major resistance line. We're now sitting exactly at that major resistance level, including the top of the bear flag, this red line, and the bottom of this prior support line, now a major resistance line. Let's take a look at the NASDAQ. The NASDAQ is getting pretty close to hitting the prior high from February the 2nd. And if it does end up going up here and producing something that looks like this, an indecision doji, that will likely produce a double top formation with a negative divergence. Overall, the NASDAQ continues to outperform the rest of the market, especially as it has the lowest weighting of financial stocks, particularly regional banks, which got really clobbered the last couple of weeks. So let's take a look at the Dow Jones. The Dow Jones is hitting yet again a major resistance level. This is a retest of the prior lows, and we're closing just below the 20-day moving average, this dark red line. If we drop a trend line that connects the closes of the Dow Jones, we'll see that the DIA probably has some minor upside left before it hits major resistance, converging on both the 20-day moving average and the descending resistance line, as well as these prior pivot points that will now inevitably act as major resistance. If we take a look at the HYG, the smart money is up above, the dumb money, the S&P is down below. We're getting another back test of this prior support line, now a significant resistance line in the high yield bonds. We're getting a back test pretty similar to this back test in the S&P 500. Overall, high yield bonds continue to look significantly weaker than the S&P 500, and that tends to lead to more downside in both of these names. Let's take a look at the SPX. Again, perfect backtest of the 50-day moving average, as well as this prior support line, now a major resistance line. This is a perfect, near perfect backtest. And if we take a look at the smaller time frames, the 1 hour chart, there's a lot to talk about here. These blue dashed horizontal lines represent the expected move for tomorrow. We have about a $5.5 to $6 move expected tomorrow. So that's a high of about 405 and a low of 393. Now, I did point out a few very significant developments on the smaller time frames, and I'm going to talk about them right now. I posted this earlier today before the market opened. We have a convergence of multiple resistance levels up above between 398 and 399. Funnily enough, that's exactly where the market closed today. We have the descending slow moving average, the purple line. This is a beautiful line right here. And the upper edge of the bear flag. Again, this is the upper edge of the bear flag. All in all, I am personally not a buyer here as we run into major resistance zones ahead of the Fed meeting tomorrow. Overall, guys, you do not want to see the market rallying ahead of an event that unfortunately prices in a lot of optimism before the event and opens the door for a lot of risk to the downside at the event. Ideally, for the bull case, you would have wanted to see the market move down ahead of the Fed meeting and rally on the Fed meeting, not the opposite. You do not want to see the market rally ahead of the meeting because that opens the door for a lot of downside after the meeting. Now, let's take a look at the important zones that I talked about earlier today before the market opened, and we pretty much got a perfect tag of those levels. We closed at 398. 0.89, again perfectly between that 399 398 threshold of this purple resistance line, as well as just below the upper edge of this bear flag. This is a very well defined bear flag right here, guys, with the lower edge acting as support and the upper edge acting as strong resistance throughout this choppy trading period over the last week or so. Now, in addition to that, guys, we do have this critical convergence of resistance levels. Number one, this prior swing high level of 401.5. It acted as resistance throughout this period, again rejected after this false break top, after this counter trend rally. Again, rejection here. In addition to that, we have this descending resistance line that acted as resistance here, and again here, again here, and again here, and again here. And I expect it to act as resistance once again tomorrow. So we have a convergence of the upper edge of this bear flag. We also have this prior swing high, and we have the descending resistance line. So a lot of resistance here, guys, at 401. And if we take a look at the stochastic of the 2-hour chart, we are again inside of the overbought territory here. So not a lot of upside potential, but again, guys, anything can happen tomorrow. Nobody knows what Jay Powell is going to say. Unfortunately for the bulls, we are hitting major critical resistance levels ahead of the Fed meeting tomorrow. Now, I want to point out what happened before prior meetings. This was a prior meeting November 2nd. Now, remember, guys, the market was in an uptrend. We were rallying ahead of the meeting, and then we ended up crashing the day of the meeting. Now, if we take a look here, we have been rallying ahead of the meeting, but we've been trading within the context of a downtrend. How do we know that? Well, if we take a look at the summation index, the summation index continues to point down. The distance between the slow and moving averages is quite significant, right? There's no tightening quite yet between the purple and the black. The histogram is still red, so the market is still decisively in a downtrend. That will not change until and unless the summation index produces a bullish crossover. These bullish crossovers, guys, usually produce prolonged counter trend bear market rallies. We haven't seen that quite yet. So right now we are in a counter trend rally within the context of a strong downtrend, and we're hitting critical resistance levels ahead of a key event, the Fed meeting tomorrow. That's pretty much the worst case scenario, the worst possible place to go long in my view, even though we have broken out today above the 20-day moving average and above this prior resistance level. But again, you do not want to be buying into a very anemic, low volume, counter trend rally ahead of a key event. That spells a recipe for disaster, in my opinion. I did point out this in the trading community earlier today. We had that resistance level exactly at 398.8 to close the day. I pointed out this critical point of failure, the backtest of this prior support line. We've hit that backtest perfectly. So if anything, guys, this is objectively a terrible long entry to go long the market here, especially if the market does not like what the Fed has to say tomorrow. So what am I doing, guys? How am I trading this? Well, I've been waiting for a solid double bottom formation to go long the market. That is still in the making. It'll probably take about a week or so more before that double bottom is complete. I've actually been up 70% on my last 3 consecutive trades, going long on this counter trend rally, shorting the market here, and then closing my shorts right about here. Now I'm waiting for a proper, really high confidence setup to try and go long the market again. And I've been sitting on cash since in my trading account. In my investment account, I've actually went long gold right here. It is now finding resistance after it hit both of my price targets. If we end up getting a bearish crossover on the PPO on gold soon here, this will look like a double bottom with a negative divergence. and gold will likely go back to retest these lows again, if not even go lower to retest this 200-day moving average. What's going to crush gold? Well, if yields rally on the Fed continuing to raise interest rates, gold will get crushed. Today we had yields actually move up and the market also rallied. So this is a major contradiction. When yields move up, the market moves down. So yields are contradicting the rally in the S&P 500. We also have that very weak volume also contradicting this rally to the upside. And if we take a look at the S&P 500 hourly futures, we have again tagged the upper edge of this bear flag formation. Again, guys, so we're hitting major resistance levels ahead of the Fed meeting tomorrow. We do have some bullish setups that I've been sharing with the trading community. By the way, guys, if you want to join the trading community, check out the link in the description below. You will be able to do so through our Patreon page. Now let's take a look at the VIX. The VIX is getting very close to back testing this prior support line. I pointed out earlier this week that the VIX is actually hit major resistance levels. It actually did it perfectly 3 times. Look at this perfect rejection of my resistance level. Once, twice, 3 times, lower highs each time, significantly lower highs on the PPO. This did set up the market for a counter trend rally as the VIX declines. We are now almost done with that counter trend rally, right as the S&P hits those major resistance levels and as the VIX will likely try and find support here. I did point this out in the trading community earlier today. I do expect some more downside in the VIX, guys, but just enough of a reaction to potentially go back down to 20, hit this prior swing high here, form somewhat of a false break bottom, and come back even higher later. Now, what tends to happen, guys, on the Fed meeting, on the day of the Fed meeting, is that the VIX tends to see a quick flush down as volatility is priced out of the market as the Fed decision is made public. What tends to happen is a knee-jerk reaction where the VIX moves down, the market moves up, and it ends up reversing the next day. Let me show you a few examples of this. Now, this was the Fed meeting on May 4th. We had this very impulsive rally. We had a correction in the VIX, and the market ended up completely reversing to the downside the next day. The summation index tends to favor this outcome. Why? Well, if you notice, guys, this is the McClellan oscillator down below, and in the context of a downtrend, within the context of a downtrend, all of these are downtrends. Within the context of a downtrend, when the oscillator switches from red to green, it usually marks perfect shorting opportunities, local tops. This is an example right here, red to green, perfect shorting opportunity. The market ended up crashing significantly following that signal. It happened again on the Fed meeting on May 4th. Again, perfect top and major correction. It's been happening systematically here, guys. Every red to green switch within the context of a downtrend and on the summation index produces a perfect sell signal. This was another perfect sell signal. This was a red to green switch intraday. This was an intraday switch. That's why I marked it on the day. And again, it marked a perfect shorting opportunity. We're getting very close to that. We will likely see that happen tomorrow as the market makes one final push to the upside, gets rejected at those major resistance levels. Again, descending resistance line, this prior swing high, and the upper edge of this bear flag as the stochastic enters major overbought territory. So that's kind of what I expect. One final push to the upside, a sell signal on the McClellan oscillator, a tag of those major resistance levels on the shorter time frames for the S&P 500, and final flush down from the VIX, and a bounce back up. Guys, notice how the VIX usually finds support once it hits the 20-day moving average. In the context of a downtrend, we have hit that 20-day moving average today. It's been happening consistently throughout these bear market corrections. Here's another example right over here, another example here, another one right here. And let me add the S&P so you guys can see what happens after the VIX hits those 20-day moving averages. Boom, right here the market topped a day later. Boom, right here the market topped the same day. Let's take a look here. Boom, the market topped on that exact day. Again, if we take a look here, guys, boom, the market topped the next day. So a lot of signals pointing to a top tomorrow. One final push to the upside. As the S&P tries to push back up above this resistance line, finds major resistance, gets rejected, moves back down, and the VIX pushes back up. Now guys, let's jump to the most important part of this video, and it's this, the put to call ratio. Here's exactly what I'm looking for on the put to call ratio. The put to call ratio, guys, is a contrarian indicator. When you have more puts than calls in the system, the market usually bottoms when sentiment turns extremely bearish. That's usually when the market finds a local bottom, right? And when calls outpace puts when the put to call ratio moves down, that's usually when the market finds a top. Now here's exactly what I'm looking for on this chart. We have had extreme bearish sentiment as the market was crashing on the news of the SVB collapse and the bank runs, and now the put to call ratio has been moving down. What usually happens next, guys, is that the put to call ratio will push back up to the upside, make a lower high like so, and like so, and the market usually finds a bottom, right? You'll see the S&P make a lower low, and you'll see the put to call ratio make a lower high, creating a positive divergence where the market sees price action that takes out the prior low, as has happened back in October here, guys, and as has happened in May right here. But you will not see bearish sentiment go back to those extreme lows, making a lower high on the put to call ratio, making a lower high on the put to call ratio, and once again, we will likely make a lower high on the put to call ratio, find a bottom here soon after the market corrects, very likely after putting in a top tomorrow on the Fed interest rate decision. So here's what I'm looking at on the daily chart. One final move to the upside tomorrow. Rejection the day after, and more selling to take out this prior low. Find support somewhere around this level, form a divergence, a bullish divergence on both the PPO, the McClellan oscillator right here, doing something that looks like this, right? As the market makes a lower low. And as we produce, again, a bullish buy signal on the put to call ratio. We're getting close, but we're not quite there yet. Now, what would invalidate a potential double bottom, guys, is if the PC, the put to call ratio, makes a new high. That would invalidate the bottom, and that would open the door for more downside ahead. So for the short term, guys, I'm looking for a top tomorrow, a rejection of the 50-day moving average, and this resistance line, as well as all of these resistance levels that I pointed out in the smaller time frames. By the way, guys, I do update this chart every single day with the critical zones, critical pivot points, supports, and resistance levels. Again, a live link to this chart will be available in the trading community if you want to do that. So potentially something that, again, looks like this, double bottom, and then we get a stronger counter trend move. In terms of the medium and the longer term outlook, I still expect this low to be taken out, and I do expect the market to take out the October lows as we get deeper and deeper into recession, and as company earnings get really damaged. We'll know a lot about company earnings in early April as those banks begin reporting earnings. We'll get an idea of how bad things really are. And again, if we take a look at the 200-day S&P 500 breadth, it has taken out these prior lows from December. And if we take a look at the 50-day breadth, we have the exact same look. We have taken out the December lows, and that will inevitably lead the S&P to take out the December lows, just as the Dow Jones did exactly that here very, very recently. Really, the only thing that's been keeping the market up is tech, and tech valuations are getting really out of hand here, especially if I take a look at some of these charts, guys. Let's take a look at Google, for example. Google has hit the first major resistance level on our chart. The next major resistance level is coming in really soon here, and that's the upper edge of this bear flag. So a lot more downside risk than upside risk ahead for Google. And it's pretty much the same picture, guys, for all of the tech sector. We're getting into those major resistance levels. Again, likely producing a top as early as tomorrow, and we'll get a much deeper pullback after that. Tomorrow, the FOMC meeting is at 2 p.m., so we'll see a market reaction as soon as that Fed decision is made. My guess is that we'll see 25 basis point hike tomorrow, and the Fed will probably signal that it's going to pause very soon after that, and I expect the market will like that on the day, and we'll see a rally on the day. And again, the market will love anything that has to do with a pause right up until all of those earnings really come in negative. And in the very short term, guys, the market will love anything that has to do with a pause. But as you all know, guys, really bad things happen when the Fed ends the interest rate hiking cycle and begins to cut rates as the yield curve begins to steepen. That's when really bad things happen in the stock market. Really bad things begin to happen in the stock market. Remember this tiny correction, yeah, the markets declined from 480 down to 350 is really a tiny correction in the context of the recession that we're staring down probably towards the back half of the year. That's when the majority of the bear market decline will come. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.